Good morning, everyone. We're getting people to still join. We are up to about half of what had already confirmed that they were going to attend. We'll give a couple more minutes for them to join, and then we'll finish our introductions and then get into the meat of our presentation. So a couple more minutes, and then we'll get started. All right, so it is 8:33, and so we're going to get started because we know everybody, with this new environment, we never know what the day brings. So we want to make sure that we provide as much information to you as possible, and also make sure that we are aware of the time, just so that you are able to get done all of those new things that get thrown to you as we learn more and more about what COVID-19 is how's it affecting our personal world and business world. So we'd like to welcome all of you who are able to attend this. This is our construction webinar called Finish Strong and Pave the Way for a Smoother 2021. We are hoping that it's a smoother 2021, and all that we see out there is showing us, when the vaccinations get through, that hopefully, as we fight through this final push of how COVID-19 is affecting us, hopefully we'll be able to push through in 2021. So we would like to thank all of you for taking your time out of your day for doing this and being able to be on this webinar. At Corrigan Krause Construction and our construction clients and our construction strategic alliance partners are very important to us. We've developed a team that manages a lot of our construction taxation, construction financial statements, and construction consulting, and making sure that we're very specialized in that industry so we can provide our clients and our strategic alliance partners with the best solutions for themselves and for their clients. Our main goal for putting on this webinar and this education is to make sure that you can find that, that golden nugget and that bit of information that you can take from today and apply to your business and apply to your work in general. So just our most important for us is for all attendees to find that one piece of information or multiple pieces of information that they can apply today. If there's ever a time when you have questions or delve more into more details than what we have, feel free to shoot us an email after. I know Megan, who helped put on this webinar, will provide some information on how to follow up with any specific questions. We're here to help. So whether you're a current client of Corrigan Krause, whether you're a prospect or prospective client of Corrigan Krause, or whether you're a strategic alliance partner, feel free to reach out to us. Our job is to inform you of what we know and share what we know. When I look into things that are important to me in general, I always go back to the sports analogy. And one of my favorite people I take quotes from is Urban Meyer, and when he works with Tim Kite, who is a kind of a business coach, personal development coach, and he talks about E plus R equals O. And I want to make sure that all of us apply this in our daily basis. So event plus response equals outcome, meaning that we don't have control of really what happens to us. All we have control of is how we respond to it. So if we make sure we focus on our response instead of the event that happened, we'll have a better outcome. So I want you to realize that when you go through here is that we're going to give you a bunch of information, and consider that the event. All right. Your response of what you do with it will determine the outcome of whether it helps your business, someone else's business, or helps you help someone else. All right. So the event are going to be all this information that we're going to give you. Your response, I hope, is to make sure that you share it and develop it and ask questions. All right. So the housekeeping for this is that we want this to be an interactive discussion. All right. And we encourage all attendees to utilize the chat function, all right, or the Q&A, and we'll answer questions throughout, and then we'll also have time at the end for additional questions. Megan will be, making sure that she goes through and sees the questions there, and if they're relevant to the current topic, we'll probably step in and answer that question right there. And if it's something we can push off to the end, we'll do that just so we don't get in the way of the speakers and the presenters. So how this is going to work is this is going to be kind of a moderated discussion with questions from our team. I'm Dennis DeLugas. I'm a director at Corrigan Krause in our construction services division. And I head up working with our construction clients strategically and making sure that we're providing all the information that we can and learning and going out and hearing what's new in our world, our accounting world, and also learning what's new and happening in each industry that we serve. We've grown a lot in our construction services group, and that's thanks to many of you that are on this, whether you're clients, prospective clients, or strategic alliance partners. We thank you for all that you've provided with us in regards to helping out your clients or our clients working with us. We're also going to go through and have each panel member right now kind of introduce themselves, and then we'll get right into our moderated discussion.
Hi, everybody. I'm Eric Dorncott. I am a director in the construction services group. It's hard to believe, but I've been doing this for 20 years now. I know I don't look that old, but I'm starting to get some gray hairs, and I think people are finally starting to take me a little bit more seriously. So I specialize in mergers and acquisitions, year-end planning, and pretty much planning for all our construction group, and anywhere from business planning all the way down to the individual shareholders planning. We do, like I said, we do a lot of mergers and acquisitions, and that's specifically where I work the most at.
Good morning. I am Caitlin Dorsch. I am a manager in the Assurance Services Department. I work a lot with Dennis. I've been doing this for about 8 years in public accounting, a few years in private, and I am the one out in the field working closely with our clients and kind of holding your hands through year ends and bookkeeping and all the problems you have throughout the year also. And I'm happy to be here.
Good morning, everybody. My name is Ryan Sklanika. I am a manager here in the tax department and with the construction service niche. Been with Corrigan Krause for 5 years now. My anniversary was actually just a couple weeks ago, which is pretty cool. I graduated from Youngstown State University, so Dennis is an alum of mine, so that's pretty cool. We're fellow Penguins. At Corrigan Krause, I specialize in tax planning, state and local taxes, the multi-state, multi-city returns. Really good at not only helping clients with tax services, but helping them kind of get their accounting, QuickBooks, if they use QuickBooks, any other accounting software to help them kind of fine tune their systems and grow as a company. Thank you.
Hey everybody, Doug Ramus here. I am a supervisor in the ASD department at Corrigan Krause. I've been here about a year and a half. I've got about 5-ish years of public accounting experience, a couple years of industry accounting as well. I work here a lot with Dennis and the rest of the construction team on this webinar. I do a lot with the construction clients. I've also done a lot with the PPP applications, kind of helping clients navigate the forgiveness applications, things of that nature. So hope you guys enjoy.
All right, thanks. Thanks all of you for being able to introduce yourselves. Actually, Ryan, you're an alumni of mine. I'm not an alumni of yours. I am a little bit older than you. So it's okay though. So what we're going to talk about here is tax planning, PPP planning, and financial statements. We think that those are probably the most relevant now because this is a year unlike any year. And you know, the middle thing of talking about PPP, which hopefully we can stop saying on there, but I don't know when the next stimulus comes. It may be PPP 2. So we'll see what happens with that. But before we start, all right, I love the 80s. I love the 1980s, all right? And so I'm hoping that I have some fellow 1980s lovers on here. So I'm going to ask a question. First one to post in either the Q&A and chat the answer will receive a prize after this, okay? So first one to post, and it can't be any of you that are on this panel, all right? Because Eric already knew the answer when I asked him. So what was the name of the pirate whose treasure Mikey and his friends were searching for in the Goonies? What was the name of that pirate? First one in the chat or the Q&A to answer that will win a prize to be determined after this. All right, Ollie Berry is the winner of One-Eyed Willie. All right, so we'll make sure to follow up with you to provide you this amazing gift of $50 bills to Ollie Berry on there. So another Goonies reference for all of you. So we're going to get into this moderated discussion, break it up into tax planning, PPP planning, and financial statements. Feel free to do your Q&A and your questions. If we don't answer them through this section, we will follow up at the end. If for some reason we run out of time and haven't answered your questions, we will answer them after directly to you, all right, via email, or if it's unclear, feel free to give us a call. We're here to help. All right, so Ryan, if you can unmute yourself. IRS Code Section 460 governs the way the long-term construction contracts are taxed. What are some of the hidden gems of Code Section 460 that construction clients and also their service providers should be aware of?
What I think it's important to know is what Code Section 460 governs, and that is the taxation of long-term contracts. And a long-term contract is one that is defined as a contract that exceeds 2 taxable years. So it doesn't actually have to be 2 years in length. It's 2 years on the tax return. So some hidden gems that are exempt from Code Section 460 are contracts that are less than 10% complete. So if you have a contract that is less than 10% complete at the end of the year, you do not have to account for that on the percentage of completion method, and you can exclude that from your net profits on the tax return. Another item is residential and home construction contracts. Home contracts are able to be accounted for on the completed contract method instead of percentage of completion. So that helps our contractors defer their revenue into a future tax year of when the construction is actually completed, not throughout the contract. No Amt adjustment on those as well. Residential contracts also include the subdivision. So you don't have to actually be a home builder or actually developing or building the house, if you are putting in stuff in the subdivisions, those jobs qualify for those exemptions. The last, or not necessarily last, but the other item that is an exemption is the small contractor exemption, which allows contractors that have $26 million average gross receipts over the last 3 years to be exempt from code section 460, meaning that they can choose how they want to account for their construction contracts on the tax method only. That is adjusted for inflation. For 2019 and 2020, it is 26 million. No word on what it will be yet for 2021.
Awesome. Thanks, Ryan. You know, the one other thing on there, just to kind of delineate between the home construction and the residential construction, is that, you know, people think of home construction of like building the homes. All right, or I'm not a home builder, so I don't have home construction contracts. But if you are in the site work or the paving world, the concrete world, and you're working with Pulte, or you're working with Ryan, or you're working with a Hovanian, you have home construction contracts. All right. So you are able to account for that on the completed contract method without an Amt adjustment, which is the best of both worlds. Completed contract, no profit until the end. All right. And also no Amt adjustment. Ryan, you also talked about the residential contracts, which is cool. The big thing with those is that it's 70% completed contract, 30% percentage of completion. Residential contracts, think about this. It's you working for CMHA and you're doing the roof. All right. That is a residential contract. All right. That is a residential contract. You're working with CMHA. All right. I have clients that have been doing the roofs on CMHA, and those are residential contracts where we've been able to defer income into a future period. So looking for those hidden gems. Great information, Ryan. Eric, can you explain how the 20% qualified business income deduction works?
Sure. In 2018, they passed the Tax Cut Act, and it basically allows taxpayers that are business owners that have pass-through entities, so S Corp, partnership, Schedule Cs, to deduct, let me say it a different way, to not tax 20% of their business income. So it's a straight 20% business deduction. So if the company makes $100,000, you're only taxed on $80,000. The one thing to remember that I do see this missed a lot is that also includes rental income. So if you're a operating entity, a business that owns your building, the rental income, if it's grouped properly with the operating company, is also able to reduce their income by 20%. This is a federal only deduction, and it's not limited by basis. So if you're having basis issues, it will not adjust for that. The basis is inconsequential to the deduction, and it's a straight 20% deduction. It's worked out really well. It in essence takes, if your business income is being taxed at the highest bracket, which is the 37% bracket, it in essence takes your tax rate on your business income down to about 29%. So it's a very nice deduction. It started in 18 and will continue through 2025. So
Awesome, Eric. And the big thing is with that is that, you know, people think that, all right, well, it's just, I'm going to get it 20%, but there is a lot of planning that goes into it, especially what Eric talked about, the grouping elections that are done to making sure that you can take advantage of all your income, not just the income that you have wages related to. All right, Ryan, you know, depreciation is an important part of any economic package that is put through tax package wise. What are any depreciation updates and limits for 2020 that our clients would need to know about?
So like you mentioned, depreciation is a big thing. On my way into work today, I was listening to 92.3 The Fan, and they had a commercial about the Ford dealership that's selling heavy trucks, and they talk about the 179 depreciation that's available to those. So there are two depreciation techniques that we can use to accelerate some equipment purchases, vehicle purchases, which are bonus depreciation and Section 179 depreciation. There are some differences between the two that I think it is very important to know. Bonus depreciation is available for both new and used. That changed recently with the Tax Cuts Act in 2018. Bonus depreciation is 100% in the year that you buy it up to tax year 2023. Every year afterwards, it decreases 20% every year until it's used up, and it'll be 0% in 2027. One important thing to know about bonus depreciation is that it can cause an NOL, meaning you can have more depreciation than you have income, giving you a loss for a future year, or carry it back, which I'll discuss in probably later in this webinar. The other item is Section 179. It's eligible up to $1.04 million. This does get adjusted for inflation. It does cap out depending on how much revenue you make, so that is important. This cannot create an NOL, meaning if you already have a loss, you cannot take Section 179 on that for an NOL. A minor thing is 179 is the first $25,000 for Ohio does not get added back. Ohio, on accelerated depreciation, you have to add back 5/6 of your depreciation. So you do not get a full benefit in Ohio as you would for federal purposes.
All right, thanks, Ryan. I know that there's probably some more stuff in the CARES Act that you'll be talking about in regards to qualified improvements too, that could, help our clients for any of their leasehold improvements that they've done on any of their properties. But thank you on that. Depreciation's important because it's that time of year where you're meeting with your professionals, whether that Corrigan Krause or other firms, and determining how do we save money. And depreciation is one way to do that, especially if you are a heavy equipment user. All right, Eric. Ryan explained Code Section 460 and what's available for our clients. Can you maybe delve in a little bit deeper into the different bases of accounting that are available for our clients under tax methods?
Sure. So like Ryan said, Section 460 governs how long-term contracts are accounted for both for tax purposes. So if you meet any of the exemptions that Ryan talked about, you can do different methods of accounting for tax. So basically, if you fall under that $26 million or you have some other exemption, you can do the cash method of accounting. And the cash method of accounting is really just what it sounds like. Cash in, you pick up income; cash out, you take a deduction for. It can turn out to be pretty beneficial in that first year that you switch from percentage of completion to cash. It can be a pretty significant adjustment. Then you have completed contract, which is you don't pick up any income until the contract is complete, regardless of when you earn the money for book purposes. You have accrual, which is just your typical accrual. When you receive an invoice, you pick it up. When you bill someone, you pick it up. Those are basically the main ones that you can adjust to when you're not doing percentage of completion. The one thing that is required, you have to do a change request with the IRS when you switch to one of these. They are, for the most part, automatic, but it still takes some time, and you still got to go through the process of sending it to the IRS and asking permission. Really, the big thing to do is if you meet any of those exemptions and you need to really look at, when you do the switch on the majority of these, there is an Amt adjustment. So although you're switching to the cash basis, for Amt purposes, for a lot of these, you're required to calculate percentage of completion. So it may be a big change initially, and then depending on the Amt adjustment, it may not be as big, but it's definitely worth something to look into. So thank you, Dennis.
Yeah, and I think that's the big planning thing, is that, you go in there and I want to be on cash basis, but you don't realize that you still have that Amt adjustment. So it is beneficial, but in that first year, you really have to plan a lot and to make sure that clients and other people are aware that It's not as big as a benefit as you would hope, but it also gives you the ability to save tax money. The other thing you have to realize too is that, when we say code section 460, is that if we have a contract that kind of spans, say that you are cash basis and this contract lasts for 4 years. If it lasts more than 2 years, 2 calendar years, that has to be accounted for on percentage of completion. So you could have like 3 or 4 different methods going on in your tax return that you have to really account for, and making sure that you're following through with it. And that's why it's so important to make sure that when you go through your tax return and your financial statement, if your revenue numbers are really the same, there's not enough planning being done. So one of the golden nuggets to take away from here is to look at your financial statement and look at your tax return, and making sure that those numbers, those revenue numbers, those contract revenue earned numbers are different. Because if not, you haven't used some of the methods that Eric's talking about.
When the AMT adjustment in the past, prior to the tax changes that happened in 2018, AMT was people that were going into AMT were a much lower amount. The exemption was much smaller, so more people were being affected by AMT. With the tax law changes, they increased the exemption significantly. So depending on your AMT adjustment, even if you do have one, that doesn't mean you're going to go into AMT. When you have significant adjustments, will cause you to go into AMT and maybe lessen the income tax effect. But it has been pretty significant for a lot of our clients. So if you haven't heard of this before, it was because prior to 18, it was very hard to take advantage of with the AMT adjustments.
Yep, and also that you were at 10 million on the average of ghost receipts and not 26 million. So that was a big difference with the TJCA that was introduced. All right, Ryan, thank you, Eric. Ryan, the CARES Act introduced new legislation during 2020. What are the planning keys that people should be aware of and taking advantage of from this act?
So the couple major ones were the net operating losses and the qualified improvement property that we touched on earlier. Those are the two main big ticket items that I think. There are more that the CARES Act did provide, but I think these are the two major ones. A lot of times that we think that, hey, we're only thinking about the current year onward, but there are things that happen retroactively that we can go back to a past tax year that was filed, and we can find some tax savings or adjustments that we can go back and change. The main one was net operating losses. In 2018, they were limited, and you can no longer carry them back. You had to carry them forward indefinitely, and you could only use 80% of that in the current tax year. With the changes, we were able to now go carry those losses back 5 years. So if you had a loss that generated in 2018, you could go back to 2014 and use that NOL and get some of your tax dollars back. What's important there is in 2014, we had higher tax rates. So we could be taking back some of these losses and getting our money back at a higher tax rate than carrying it forward at a lower tax rate. The other item was qualified improvement property. When the Tax Cuts Act came about, it was assumed and thought of that qualified improvement property was going to be 15-year property. However, it never made it into the code and was never written that it qualifies for 15-year property. And what's important there is, since it's now considered 39-year property, that is not eligible for bonus or 179 depreciation, meaning any qualified improvement property has to be depreciated over 39 years, which will take a long time to get the full benefit. Well, with the CARES Act, they went back and changed it so that you get 15-year property, which is important because that does qualify for the accelerated depreciation methods, meaning you get the full tax benefit now.
All right, thanks, Ryan. I know that that CARES Act especially in our industry with the construction and accelerated depreciation and generating NOLs and other items like that, it's very important to look back because, as Ryan said, when Trump entered the White House and was able to to reduce taxation. You have the ability to go back to the Obama era taxation rules to get money back, which is drastically different from where we're currently at underneath the Trump administration. So plan. Eric, anything else as you look through this year and this year end of some of the information that you're providing to our clients that could be helpful to people on this webinar?
Sure. First thing I want to talk about is, and not to get political, but to talk a little bit about the election and what could or couldn't happen. I know a lot of people are stressed about tax rates going up and what could happen. But the way it stands right now is we don't know enough. Unfortunately, everything hinges on the Georgia runoff election of the senators. So as it stands right now, the Republicans control the Senate. And if that's the case, you'll see very little changes. You probably will see some small tax increases that they would need bipartisan support for. But if the Democrats end up winning Georgia for the Senate, and it shifts the power of the Senate to the Democrats will have both the House, the Senate, and the presidency, and you could see significant changes. Some interesting changes, good and bad. So it just depends on where you're looking at it, what lens you're looking through. But right now, as it stands, you might not see much change if the Republicans control the Senate, because they probably won't let a lot of things through. But I did want to give you just a little bit, kind of some nuggets of what President-elect Biden's plans were. He really targets people making over $400,000. So if that's the case, you will see the highest bracket, which right now is 37, revert back to the previous bracket, which was 39.6. The other thing you will see, which is pretty significant, is, and this didn't get a lot of traction, but during the election, we didn't talk about it a lot, but it would be to increase anyone who's who receives income over $400,000. Your wages over $400,000 would be subject to Social Security again. Right now, it phases out at about $137,000, but if you make over $400,000, you'd have to pay another 6.2% Social Security, as well as the business owner. So the employer and the employee both get stuck with that 6.2%. And it will also, probably the biggest change would be to eliminate the qualified business income deduction that we previously talked about, but that would only be for income over $400,000. The positives are they would increase dramatically the dependent care credit and the child tax credit, as well as you would see a lot of credits available for energy efficient property, whether that's residential or commercial, that would get pushed significantly to the forefront, which could help a lot of our construction clients. And the other thing I did find interesting is they have suggested a $15,000 first-time home buyer credit. I know years ago that was about $8,000, and it was pretty significant for the real estate industry. So that could be a very good thing. A couple other things to think about is, some of you may have had a down year this year. If you are thinking about switching accounting methods and you can create losses, I know Ryan touched on it a little bit, but if you can create losses for the current year and carry them back, that could be significant. But also, if you do have a loss for the current year, and you have an IRA, could you convert it to a Roth IRA? We've done a lot of planning where we create losses of $100,000 and we convert an IRA to a Roth of $100,000, and that's to zero tax. And you've transferred that asset from a future taxable event to growing tax-free now. We've done that. There is some Section 179D that is still available, and that is for energy efficient improvements to buildings. It's based on square footage, and it can be, if you're doing any work for governments, the contractor can end up getting the credit. It's based, again, it's an amount per square foot of the building, and it can be pretty significant for the contractor if they're working on nonprofits or governmental contracts. Otherwise, it would end up probably, for the most part, going to the owner of the building. And last but not least, we do have some R&D credits that we're seeing that available for a lot of construction clients. And basically, if you're creating a new process that requires some testing and something that's new to you, there's a potential for R&D credits. You should really talk to us or talk to your current CPA about that. It can be significant for some of our clients. So those are kind of the nuggets I have right now.
Awesome. Thank you, Eric. Yeah, as you know, every year, this year, way more than others, it's important to plan and know what you're getting into, because usually when 12/31 hits, there's really hard to do anything retroactively. So it's important now from the end of the year to get with your CPA and making sure that you're planning for all of these items on there. All right, so we're going to switch over from the tax area down to our favorite PPP planning. And I know that everybody on here probably is an expert in the Paycheck Protection Program, because we were inundated with information. So we're going to kind of go through kind of what's happened, how do we get here, and what is the current environment that we're living in with the Paycheck Protection Program, and how do we handle forgiveness and other items like that. So Doug is going to help this area and kind of answer through some of the questions that we have. And then Eric will chime in at the end when we talk about taxation with the Paycheck Protection Program. So Doug, where are we currently at with the PPP program?
So yeah, right now, thanks, Dennis. So a lot of the banks are sending out invitations to online portals. That's typically how most banks are handling it. And online, once you get the invitation, you're able to sign into your account and fill out information. It mirrors, a lot of you have probably seen the PDF forms that have the different criteria that need to be filled out, and the portal just kind of essentially mirrors that, where you fill out the information regarding the loan amount, the period that you select, the amount of payroll costs, and then you pretty much upload any support that's relevant to how you spent the funds, and then you certify it, and then at that point it's submitted. The bank has 60 days to review these applications, and then it goes from the lender to the SBA. The SBA has an additional 90 days to review. So there is, potentially a lot of lag time there. There's not any precedent really, so it could be sooner in some cases, but we don't really know. But they do have, quite a bit of time to potentially review those.
Awesome, Doug. Yep. So we've come a long way from when we were running to get the money, and now we're figuring out, well, all right, it's come to the end of those 8-week, 24-week, and what's the next shoe to fall. And now we know here it's not as much as a mad rush to do these types of things, because we do have 10 months from the end of your covered period to apply for that forgiveness. So the IRS, Doug, has come up with 3 different forms. I mean, the SBA has come up with 3 different forms when you're filing for forgiveness. Can you explain the difference between the 3 forms?
Sure. So there's 3 forms. There is the 3508 EZ, which is the simplest form. But it's only for loans under $50,000. It essentially it's basically one page, whether it's online or not. It's pretty much just a few questions. You're certifying everything, certifying that you spent the funds in appropriately, and you may have to submit maybe like a couple payroll registers that show how it's paid. There's really no FTE. There's really no FTE considerations there. And I think I misspoke there. So 3508S is the under $50,000. So that's that form, 3508S. Thanks, Dennis. The 3508EZ is if it's over $50,000, but but you meet other criteria. So for instance, you're self-employed with no employees, or borrowers who did not have any salary reductions or hour reductions greater than 25%. So that's the other form. Again, it's similar to the 3508S. There's a few more questions you need to answer on there. But again, it's basically certifying that you're FTEs. So you're taking it a step further there, but it's still fairly straightforward. And then lastly, there's just the 3508, which is if you don't meet either of those two criteria, you have to fill out the 3508. And the 3508 has all the same questions, but it also has a separate worksheet. They call it Schedule A form, and then there's a worksheet, a Schedule A worksheet, and that kind of lays out your FTE calculations where you're going through each week and you're comparing during the covered period in which you had the loan, you're looking at the hours worked during those weeks and comparing it to one of two different comparison periods in order to see, if there's any sort of FTE reduction that could cause you to lose some forgiveness. So those are the three forms that are all, that one of which is to be filled out for the forgiveness.
Yeah, and one of the things at Corrigan Krause that we've been working with is really helping our clients determine which forms. I mean, the 50,000 and below with the 3508S is easy to know, but it's really that determination of the 3508EZ or the 3508 in regards to which ones that you should be doing. And we have a COVID response team at our firm. So if there are any questions specific to that, and you're a current client, prospective client, or a strategic alliance partner on this line, please feel free to reach out to any people on this, and we'll try to help you out the best that we can. So Doug, like in anything, this thing was pushed forward fast and furious, and then there were changes. All right. So can you just talk about some of the big changes that happened after the fact of when people applied for the PPP money?
Sure. So initially it was just an 8-week period. You had 8 weeks to spend the money. I think what they realized shortly thereafter is there were a lot of companies that either they weren't allowed to be operating, or they weren't operating at full capacity. So that they gave you the option to extend that to a 24-week covered period. And they also changed the payroll requirement from 75% minimum to 60% minimum, which gives you a little more flexibility there in terms of spending on some other costs that are eligible, utilities, rent, things of that nature. And the other thing that came about recently was with regards to rentals, there is something we have to be aware of, and that's with related party rentals. Those rentals are no longer deductible unless the interest component is, but the rentals themselves on the rental expense itself if it's a related party rental, is not allowed as a forgivable expense. So that's kind of that's a big deal for a lot of our clients, a lot of people we're working with. So the good thing is that they extended out the period, so that's giving you more time to spend the funds on payroll and appropriate costs. But and we'll probably get into this, but you kind of have to determine, and we help work with clients on determining what's the best timeline to use, whether you want to use an 8-week period or a 24-week period.
Awesome. Thanks, Doug. Yep. The big thing there with the related party rentals, like you said, is that, yeah, they did change it, but they do give you the 24 weeks, which, the payroll is, when you go through it, the payroll is the easiest to prove out because you're showing payroll reports. The other stuff, when you're proving that out, you got to upload receipts, canceled checks, bank statements, invoices. So if you can do payroll, you do payroll on that. So recently we've heard a lot a lot of items coming up with this $2 million area. You know, the first thing was every loan over $2 million is going to be audited. All right. Now that they're coming up with these new things, can you give an update on the people that have borrowed or have taken out Paycheck protection loans of 2 million and above?
Sure. So there's there's additional forms now that, you know, that was kind of the $2 million was kind of that sweet spot where they were putting more scrutiny towards. And fairly recently, they've determined that there's additional forms that need to be filled out for those loans over $2 million. So there's the 3509 and the 3510. The 3509 is for just for-profit companies. 3510 is for nonprofit. And that's essentially just a loan necessity questionnaire. So it goes into detail. You know, you can Google that and see what it looks like if that applies to you. But there's quite a bit there in terms of what it's asking for: liquidity, you know, your available sources of. It's looking for your available sources of cash. It's basically just wanting you to certify that you really needed this money. It's just a detailed questionnaire. So if you're in that situation or know anyone that is, we can help kind of navigate that process.
Yeah, and the biggest issue that we have with that and our constituents in the AICPA have with that is that it's asking questions that are completely irrelevant of our clients attaining the PPP loan in excess of 2 million. It's asking to compare periods after you receive the money, not prior to when you receive the money. So, I mean, we're fighting with our constituents from the AICPA to kind of have this pushed away, because we believe that this can turn into some type of witch hunt of going after clients or customers or whoever that received this $2 million, because the questions that they are asking are irrelevant to the people that necessitated getting these loans. So if you read that and you are concerned about it, you got to comply with it. But yeah, I agree with what is a lot out there, is that it seems very overreaching to us, and hopefully it will get fixed. I do see a question on here, but we're going to probably push that closer to the end, Laura. We will note that, and if we don't note that, we will answer you directly after this presentation. The 8 weeks or 24 weeks, Doug, we talked a little bit about this, but you know, does it really matter on that 8 weeks or 24 weeks?
So the big thing here is we're looking at how much is spent in 8 weeks. You know, if you have enough costs spent in 8 weeks, the advantage to filing it is that if you subsequently, after the 8 weeks, had employee layoffs, you know, you won't be penalized for those layoffs if you're using an 8-week period. However, if you're using the downside is you have to kind of make sure you have enough costs that cover that, and that includes, you know, there's the payroll. You meet all the payroll requirements, the 60% minimum. You also have the limits on employees. So employees for that 8-week period can't be over, I think it's 15,385. It's 100,000 when annualized. So you can't have anyone over those limits. So you have a little bit less wiggle room there. But if you have FTE issues that arose after the fact, then it may be advantageous to go for an 8-week period. The 24-week period may be advantageous if you didn't spend enough money during the 8 weeks and you wanted to extend that period out. If you didn't have any FTE issues, if you kept everyone employed, there were no layoffs or issues like that, then you may be best just using the 24-week period, just so you can keep things simple. Just use payroll costs. You don't have to rely on any of those kind of gray area other expenses like your rentals and stuff, and providing more support. It's just more simple to just focus on the payroll costs if you can. So those are kind of the things you want to consider when you're looking at an 8-week period or a 24-week period.
Okay, thanks, Doug. I mean, I know that there's planning for everything that we see. So, I mean, it's important to realize that you do have that option. So now we're going to switch over to kind of like the taxation piece. And should I wait for forgiveness or apply now? And Eric, can you kind of talk about the reasons why you would want to apply now? I know Doug talked about the 60-day for the banks and the 90 days for the SBA. If I add that up, that's 150 days. So that seems a long time away. But can you talk about the options available and what do we see on the taxation side?
Sure. So this is really a confusing area right now, and we really need to get more information from the government as to how they're going to deal with this. But originally, when we were looking at this, and this is the vast majority of CPAs, there was a thought that if we waited to apply really late in the year, you didn't get approval until 2021, that you wouldn't have it in income in 2020, you'd have it in 2021. But the problem with that line of thinking is it's not that the income is taxable. So the income is not taxable. That they've come out and said that the forgiveness income is not taxable. What is not where they get you, and it's really just a backdoor way of taxing it, is saying that the expenses that you paid with that money are not deductible. So even if it gets forgiven in 2021, the expenses that you paid in 2020 are not deductible. So there's a couple ways of doing this. Again, we are waiting for more information to see if that's truly the case, but I will tell you the vast majority of CPAs are taking that view. Now, depending on your situation, maybe you feel comfortable doing that in 2021, but that's something you'd have to talk about and really plan to decide. We are seeing that the administration wanted this to be completely non-taxable, but I don't know that that's going to happen. We are planning for those deductions not to be deductible in 2020 for the vast majority of people. So I still think it's fine to wait and apply later if you feel you aren't going to get some of it. If you feel like 100% of it's going to be forgiven, then I would maybe wait a little bit longer to see what happens. We probably won't be filing tax returns until we get clear understanding of how they're treating this income. And if you are going to have some income that is not forgiven, maybe go ahead and apply now, because then we can take those deductions here in 2020.
Thanks, Eric. But definitively, the IRS has not come out saying that we have to do anything in regards to matching of when we spent those expenses or when we have those expenses in regards to making sure that we don't deduct them in the current year. There's no definitive guidance.
There's no definitive guidance as of this moment.
Awesome. So I'm gonna have one more of my trivia questions at this point. So if you love 80s movies, you should know this one. But again, post it into the chat or the Q&A. First one there will win something that Megan's gonna pick out, and it's gonna be really nice. All right. So in the movie Stand By Me, what were River Phoenix and his friends searching for? All right, Scott Wagner, dead body, you are correct. Follow-up question. All right, and this is where the big dough will come from. What was the name of that dead body that they were searching for? Post it in the chat or the Q&A. And I know that you guys are searching on the internet right now to figure out the name of that because it's taking longer than it is. No one on my team could get this right away. So we will, there it is, Ken Roddick, Ray Brower. Good job, Ken. You were the fastest typer to search that in your Google. All right. So we're going to go on next to the financial statement area of this. And Caitlin Dorsch will be heading up, answering some of our questions. Feel free to use the Q&A to ask any other questions. And then after this, we'll follow up with if there are any questions and answers that we haven't answered, and then kind of conclude with some final closing thoughts. So Caitlin, can you speak to the options available? Eric and Doug were just talking about PPP for taxes and in general, but what are the options for our clients in regards to PPP presentation on the financial statement?
Yeah, absolutely. Thanks, Dennis. So there are 4 options available. Some of them aren't really going to be applicable to our construction clients. So I really want to focus on 2 of them. I'll tell you a little bit about them and then maybe when you should be using which model. There's the debt model. And so this is when you're showing the PPP loan as a loan on your balance sheet. It's a liability. It's broken into short-term and long-term, just like all of your other loans are. And you are not recognizing that as income in the current year. So it's showing as a loan and you're recording the expenses as Dennis and all the other team members have talked about as if you incur them. With this, you're going to accrue some interest. You have to look at how much interest was on the loan document. I believe it's the 1% and record that. The other option is a grant model. And so this is only if you expect to get 100% forgiveness. And so what you would do is record your expenses no matter what, and then you're going to record the income as you incur the expenses. So it's going to start off as a liability on the balance sheet, and as you incur the payroll or the utilities or the other costs that go with that, you're going to record that to other income or offset the expense. And which one you do, whether you record it as income or offset the expense, will depend on your individual company, your covenants, things like that. It might make a difference, and each person will have a different approach. The other 2 models are a gain contingency model, where you record the loan as a liability and don't record it to income until all contingencies have been met. We don't expect this model to be used very often, so I won't talk about that too much. And then there's a 4th model specifically to nonprofits. So the debt model, you will use that if you question your forgiveness, if your full-time equivalents are not restored by the end of 12/31 or the period at which you apply, or even if you ask for forgiveness, even if you expect forgiveness, you can use this debt model. As far as the grant model, you will only use that model if you expect full forgiveness. The one thing that we have noticed from speaking with our bonding agents is that even if you use the debt model, they will probably be considering 75% of your PPP loan and taking that into income. So the agents, the banks, they're all going to be looking at this and probably have a specific approach. So from what we know right now, even if you're using the debt model, it will be considered as income potentially at 75% in the current year.
Awesome. And, we'll help, but the big thing is communicate, talk to your agent, your surety, and your bank in regards to covenant presentation and working capital and debt to equity to ensure that you're not setting yourself up for failure in regards to how you present this. So communication is key. And we have a lot of good strategic alliance partners on the phone, on the webinar right now. So just make sure you reach out to them and keep them involved of what your questions are, because no one likes surprises. So Caitlin, ASC 606. I know everybody on this knows what AOC 606 is, but there was a big push last year and in these years to change the revenue recognition model for everybody to have it more streamlined across industries. Okay. So how has this affected the construction industry in regards to how they recognize revenue?
Yeah, so ASC 606 really broke down revenue, and it made all of our construction clients and all of our clients across the board really look at what is a contract and what is involved in our specific contracts and break it down. What we found with our construction clients is that they use a percentage of completion method, and they were already kind of breaking down revenue based on performance obligations. So they were already recognizing their revenue using the percentage of completion method as they were allowed and over a period of time. Sometimes we did have warranties that we needed to consider accruals for, but really the biggest change that we noticed was in our disclosures and talking about performance obligations and what you're informing your financial statement readers. But more often than not, the change to our construction industry was fairly minimal, if any, at all.
Awesome. Thanks, Caitlin. I was hoping you were going to say that. One option that we've always had in the construction industry, just because, working capital, debt to equity ratios are important for us competing in the public sector, is we had off-balance sheet financing was typically available, meaning that we didn't have to kind of record the debt. So it really didn't affect our financial statements. And it's always been an option for our clients. But we've heard through the grapevine that this is coming to a change. Can you give us an idea of what we have to look forward or prepare for in the future, or when that future comes, and kind of give an update as to what that change looks like?
Yeah, sure. So historically, if you've had a capital lease, it's always been recorded on your balance sheet as a liability. And so that's going to stay the same. But if you had an operating lease or a rental where you paid, had a contract for 5 years, and at the end of the term, you did not own the vehicle or the equipment or whatnot, you did not have to record that on your balance sheet or consider that. And so starting in years after December 15th, 2021, all of our leases will go to the balance sheet. And so this will affect your current and long-term liabilities, your ratios, as Dennis stated. And so I think we just need to be aware of what we have out there, what we're expecting to get into, what do our leases look like, and realize that this is going to change starting in, I guess, essentially 2022 year going forward.
Awesome. Thanks, Caitlin. So yeah, I mean, it's a big change. Again, make sure to talk to your bank, your bonding company, to make sure that they understand how the presentation is going to affect you. You always got to look in that when you have your notes, you get a reviewed financial statement and audit, look in the notes to the financial statement in the operating lease section, because that's a big driver for what the potential changes to your financial statement could be on there. So when you look at financial statements and how different they are, because we do have the percentage of completion, the work in process, it's, what's the most important financial item that a construction company should invest in to help them?
I would say hands down that you need a solid job costing system. You need to understand what's going into your jobs, what kind of profit margins you have, make sure that you're allocating overhead and all the things that really cost and make up the costs on each job. I think it's really important to understand that in order to effectively run your business.
So the investment in software or people would really help clients know where their jobs are. The worst thing is to think you're doing well while it's happening, and then at the end realize, wow, where's all the cash? So if you haven't invested, or if you're not going to, or if you're still on QuickBooks, there's ways to utilize both systems. And I think where us at Corrigan Krause really can help people is to make sure that they understand how to utilize those systems to provide accurate data for your PMs and yourself to make a good decision. So I agree with you, Caitlin. The last question in our financial area is about analyzing the balance sheet, because a lot of our us as accountants, we're balance sheet driven in general, but a lot of our clients are probably more income statement driven, of seeing how the current year is going, and making sure profit margins are there, and understanding what our burn rate is on our overhead. But when we look at it and analyze a balance sheet, what should our clients in the construction world or in any industry really pay attention to on that balance sheet?
Yeah, there are kind of two key ratios that we pay a lot of attention to, the working capital and debt to equity ratio. And so working capital is essentially your current assets over your current liabilities. And so what does this tell you? If you look at your cash, your AR, all of the liquid assets that you have, is that enough to cover your liabilities that will be due within 1 year? And so we look at that and consider that, and you want to have enough assets to cover your liabilities that will be coming due. As far as our debt to equity ratio, how much of the company's growth has been financed through debt? Is this come from you, or has it come from the growth of the company from good years? And so we look at that also and consider how much has come from debt and from financing, and how much has come from the operations of the company and the owners.
Yeah, and I agree with that, is that, in our world, and also, in the surety world, which, you always have to kind of appease to the people that are involved in your inner circle, is that the working capital and the equity components and anything that we can measure those are most important. The one thing I'd like to add on that is that, industry-wide, when you look at it, is anytime your debt to equity gets, close to that 3-to-1, meaning 3 times the amount of debt to equity, is where you really have to sit down and determine what you want to do. That's kind of like the warning sign line in your industry, in the surety industry, for having too much debt to equity. The other thing too is that when your equity component is made up of net equipment, so if you look and you're like, I got $1 million of equity and $800,000 is in my net equipment value and $200,000 is in liquid assets, you kind of want to figure out and make sure you communicate with your bonding company, your surety, to say, what are you guys looking for? Because, when the jobs get bad, I don't think the surety world likes to have your equipment. They much rather have your liquid assets. So we just got to be aware of those things, because they're just so important of the decisions that you make. Also, talk to your bonding agent about what assets are includable and which are excludable. You'll have prepaids on there, and for the most part, your prepaids are excludable from your working capital when they look at it. So not only are they excludable from your working capital, they're excludable from your equity. So what makes a big difference with that is that, let's say you had prepaid income taxes. You are a C Corp, your prepaid income taxes, and you put it as prepaid income taxes on the financial statement and not refundable income taxes. All right. You just want to make, and maybe you don't even lump them together. Maybe you just lump it all as prepaid expenses. You don't break it out. Well, the refundable income taxes will be available in your working capital, but prepaid expenses won't. So presentation on your financial statements is very important to make sure that you have enough bonding capacity to do the jobs that you want to do on there. I think we'll probably ask one more question in the financial area on there is, we always hear about, the biggest difference in our construction accounting financial statements are the contract asset and contract liability. So, our cost in excess and our billings in excess. And I also think when you look at these in comparison to your WIP schedule, they tell you certain things that no other financial statement in the world can tell you, because our financial statements in the construction industry disaggregate data down to the profit center. You never really see that in any other financial statements. So I can tell, or we can tell, by looking at your financial statement, certain areas on due to your underbillings and overbillings. Caitlin, can you talk about maybe some of the risks associated with costs in excess, which are underbillings, and billings in excess, which are overbillings?
Sure. So as far as underbillings go, from this, I worry about a project management and a cash flow perspective, kind of the two areas. So if you're not billing, you're incurring a bunch of costs, but not billing appropriately to the client or not in time, you might have a slow billing process. Maybe you don't have a good handle on your job management. And so maybe you should be billing and haven't yet. So I would question whether there are unapproved change orders, are jobs correctly estimated. I would kind of dig more into your processes and whether you're properly keeping good good track of your jobs. And then of course the cash flow perspective, in that you're incurring these costs and not receiving the revenue to cover these costs. As far as overbilling, it's not quite as concerning, and it may help. Sometimes we bill our construction clients and they're slower to pay and have slower processes. So we do understand that. We don't want your accounts receivable to be super aged out and old on your AR aging. What we do worry about a little bit is job borrow. And so if you have a $100,000 job and you've billed $20,000, 4 times, and you have your final progress bill of $20,000, but you still have $30,000 of cost to incur, and you haven't really considered the fact that you've been overbilling all along, you kind of have a cash flow issue also, and that you have to expend $30,000 and you still only have $20,000 left. So I think it's important to consider both ways, and a job management system, a job tracking system, as we talked about, will really help you keep an eye on these things as you go and point out any discrepancies and underbillings and overbillings throughout your project.
Yeah, and I agree with that. Caitlin, it all comes back to the job costing system, making sure that you have information ready to be able to discuss jobs at any point in time. It always stinks when you have that you want to get that bid bond on a nice job, and your system isn't up to date, and you have to rely on other people to make sure to get that information to your bonding agent to get that bid bond. So, our recommendation is that, for all construction clients, you should at least have a 630 comp with job schedules and a 1231 review at a minimum, just to make sure that you have your financials are never more than 6 months out of date. It's very important on that, so you're more flexible with your bonding. The other thing with overbillings that I want to make sure, because Caitlin had a good point on there, is job borrowing. So how do we ensure job borrowing doesn't happen? I always like to look at overbillings are only as good as the cash is in the bank account. All right. So if I'm overbilled, I usually want my ratio between my overbillings, so my billings in excess, and cash to be 1 to 1. All right. If they're not 1 to 1, there's that potential for job borrowing. So again, we always want to be net overbilled, but in some industries we cannot make that happen on there. So Caitlin, thanks for some of that information. In regards to the financial aspects. The last part is that we wanted to have some Q&A if possible, but I don't see any current Q&A besides Laura's question, which we will follow up. Doug will follow up and discuss directly with Laura and also her team member at Corrigan Krause. My last trivia question. All right. We talked about a formula at the beginning of this presentation. All right. And formula that we talked about. All right. And who can put that last formula that we talked about in the chat the fastest? All right. That was a formula that I talked about in the very beginning. That was there we go. Oh, Frank won. Frank from North Star Contracting won. E plus R equals O on that. So Frank, we will follow up with you for your prize. So the event again was what? This presentation. All right. The response is, what are you going to do with the information that we provided with you? And that will determine the outcome. So our idea here is find that golden nugget in here. If it needs to be clarified, follow up with someone on this webinar. Also, you'll see any questions, info@corrigankrause.com. Even if you're not a current client, if you're a strategic alliance partner, follow through. We're here to help. We're all in this together to kind of navigate through these next 2 months. And our feeling is that the more we help in general, the economy, and making sure we conserve our working capital, we're helping our industry, the construction industry, which is very important to us. So thanks again for joining us. We hope this was informative. Thanks to all the panelists on here for preparing. That means a lot to Corrigan Krause and also to our clients that we care so much about providing this information. And thanks to Megan Hiles, who helped coordinate this webinar. Without her, we would just be fumbling our way through doing this because we are accountants and not marketing people. So thanks to all those involved. So feel free to email any of us directly with the additional questions. And remember, a problem shared is a problem solved. So if you have an issue and you don't share it, you're never going to solve it. So feel free to reach out with us. Also, Megan will be sending out a survey, and we'd like to hear feedback from you in regards to maybe topics that you would like to be talked about in future webinars, or just general feedback on how we did. We like to hear from you and figure out ways that we can improve our presentation and information that's important to you all. So feel free to do that. Also, Megan will provide a link that this will be recorded and we'll have a YouTube to our YouTube channel. I'm not a YouTuber. My kids are, I think, when I allow them to be. And so you can go on there and also share with your team because there's a lot of good tidbits out there. Now remember, the golden nugget, find it, use it, E plus R equals O. Make sure that you take advantage of it and live your life like it. So thanks again, and have a great rest of your week and a good weekend and a good holiday, safe with your family.